All right, welcome back. I know it sounds like we've had the same conversation for a while now, but Quint, what's going on in the markets and what's happened this month?
Yeah, it's been an interesting month, Logan. So we're shooting this on Friday, September 30th, to close out the month and especially important, the quarter. And why that's important is a lot of institutions and money managers sort of make, quarter end moves. It's called window dressing a lot of times to make their portfolio maybe not look as vulnerable to markets as they maybe were during the quarter. So we're seeing a lot of things today in the market that I'm not so sure are normal. It's a little more interesting today as we see certain sectors of the market really getting hit and others kind of bouncing. But nonetheless, it's been another very taxing month. Now, seasonally wise, when you look back historically, September is traditionally one of the worst months of the year. So, seasonality has played out. In particular, the challenges that we saw this month, again, are ramifications coming from the inflationary pressure, the Fed's response, and ultimately this sort of tail risk, if you will, that we're starting to see, which is the significant rise in the United States dollar. Now, let me explain that for a moment for folks at home. When the Federal Reserve raises interest rates, they don't go back and twist a dial. They don't go, to some back room and go, oh, we're going to crank up the Fed funds rate. What they do is they buy and sell United States Treasuries, either putting money in to the system, making it more plentiful and therefore easier to borrow and therefore rates going down, or they take money out of the system. They basically remove money from the system, making money less plentiful, more in demand, and harder to borrow, therefore the rates go up. What's happened is by them removing money out of the system, it applies upward pressure on the United States dollar. We've talked about that previously, where the dollar is moving considerably higher. It's at multi-decade highs right now against a variety of other currencies. Now, I don't want to lose you in this because it can be very interesting from an economic standpoint, but here's the dilemma that we face. The number one dilemma is that as our currency rises, it makes it very difficult for international companies in the United States, right, to deal with that, because as they're selling goods and services overseas, and then they look to bring that money back in, they can lose money just on the currency fluctuation. I explain it like this. Let's say that you go to Europe, you convert your dollars to euro. Right now it's 1 for 1. So let's say you take $1,000, you convert it to euros, and you go over to Europe. For whatever reason, you don't spend a dime, okay? Just so happens you don't spend a dime, but while you're there, the United States dollar appreciates, goes up, right? 10%, okay? So you come back with the same 1,000 euro that you had, and you turn that in thinking you're going to get $1,000. You're not. You are going to get 900 American dollars. Even though the dollar went up in value, the euro went down. You have lost money. You have lost $100 in US dollars just going overseas and coming back.
Yeah.
Well, that's the same concept that international companies based in the US are facing. In fact, Nike reported last night that they're facing a $4 billion, with a B, $billion loss due to the currency fluctuations. Now, that's wreaking havoc on our markets. It's adding additional pressure. This is in addition to just the interest rates going up, borrowing costs going up, etc. This is adding additional pressure. In addition to that, countries around the globe are leaving their currency because it's going down against the dollar, right? And moving to the United States currency in addition, because we're paying now very good interest rates. So the demand for the dollar has never been stronger. Now, this can potentially cause problems above and beyond what we've seen in the stock market. You may have heard something about the British pound this week. They ran into significant problems because of the dollar appreciation. 2 weeks ago, we saw the Japanese yen run into some similar problems. So what's happening is, around the globe, the Federal Reserve, make no mistake, this is the Fed's doing, the Federal Reserve's actions going as far as they're going is starting to have negative ripple effects around the world. Now, where's the silver lining, right? I said on the radio on Jack this week, we have to be optimistic. We don't have to be, but I choose to be optimistic because I feel like we've been in this situation so many times, at least over the last 20 years of my career, that ultimately you have to be looking for, okay, we know all the bad that's happening. We know all the bad that can happen, but what is good? What's good that could happen? I remember talking about that during the COVID crash and thinking what's good is that we might have a cure, or we might have, turns out it wasn't necessarily a cure, but we might have something that helps us out in this, right? And ultimately that did transpire. Now, in this situation, one of the things that's fascinating is that the economic data that is coming out is starting to get very bad. It's starting to be very negative. Mm-hmm. Why is that interesting? Why could that be a positive? Well, the Federal Reserve are making their moves based on their idea of inflation with a very strong economy. Well, I and many others are sitting here scratching our heads and going, the economy is not that strong. In fact, it's very fragile, and you're potentially, going to break this economy, and there's no kind of turning back when that happens. This morning we had the Purchasers Manufacturing Index report come out, and that's a report that surveys purchasing managers across the country to determine their confidence level of buying, right, goods and services in their manufacturing world, if you will. 50 is kind of the line in the sand. Above 50 is a positive. Okay. They're seeing expansion. Below 50, not positive, seeing contraction. It's usually fairly narrow. 51, 52, 49, 48. It's kind of in that range. This morning it was 45.
Yeah, so now, very on the low side.
The very, very low. To put that in context, the last time it was this low was during 2020, during COVID, when those manufacturers were shutting down.
Right.
So it is as negative as it's been since then, and prior to that, you have to go back many, many years. The reality is that the data that we're seeing come out does not, it just does not correlate with what the Federal Reserve is doing.
Which is saying that there's a super strong economy and that it's no problem that we raise
and they need to fight inflation because it's here to stay, and it's ridiculous. Okay. Now, that said, what's interesting is that came out. Normally, that would be perceived as, wow, this is bad. This is not good economically. The market immediately turned to the positive on that news. Now, you have to think about this a little bit out of the box. Why on such bad economic news did the market turn positive? Because it's interpreting that hopefully the Fed wakes up and says, this may be not the course of action that we need to take. Let's dial back a little bit. Not cut, not change, but at least maybe pause or, kind of not talk so tough. And ultimately, that's positive for stocks. Now, our contention, at least here internally, has been that the Federal Reserve really wanted to get through this month. It was very important for them to get through this month. And the reason it was important is because at the end of this month, right, we stop, we go into the next month, obviously, but this month is going to be measured in the next CPI report that comes out on the 13th.
Yeah.
And this month, by all intents, all variable standards, at least, unless there's something in there that we're just totally unaware of, all of those inputs are down, and down considerably. So it wouldn't surprise me in the least if on the 13th we see a much more subdued CPI report. Now, make no mistake, it's still year over year. which means we're going to have to go many, many months until we see that 8.3 come down considerably. But we could get into the 7s, maybe even low 7s next week or in the next 2 weeks, and that would be very good for markets. The point, I'm not letting you say a word or ask any questions, but I'm just going to keep going. The point is this. The market has been challenging. The market's been very, very troubled this year. It's been one of the only times in my career I can ever remember that it's really a self-induced market decline, meaning the powers that be are truly trying to bring prices down to fight inflation. My personal opinion, and I share it with Jeremy Siegel, who we watched it multiple times, came on CNBC. He's a Wharton professor, and he really went off the rails talking about how poorly a job the Fed has done and is doing, and we echo that sentiment. So it'll be really interesting, but the summary of it all is that a lot of quality companies are trading at levels now that are very attractive. And it's an environment where despite all the challenges, you're looking at this and going, holy cow, this is more of an opportunity than anything else. It's been a very difficult year coming into the fourth quarter. October traditionally starts out poor and traditionally ends really well. We're coming into an election season. There's a lot of catalysts that could transpire here going into the end of the year for a positive surprise.
Yeah, I mean, I think that there's a lot of different variables out there, but the biggest one that we really have to wait for is about 2 weeks from now when we get that CPI data that's for September.
That's right. And in addition, there's a lot of new kind of saber rattling regarding Russia and Ukraine. And depending the report you read, some reports say that, both sides are willing to talk. Then another report says, well, they're mobilizing troops and they're looking to take further action. So that's really almost impossible to handicap. But that tends to be something that's transpiring there that we're probably going to see in the next few weeks as well.
Okay, great. Well, I think we're going to wrap it up there. Just want to say to everyone out there, for our listeners that are in Florida, I hope everybody is safe out there, and I hope everybody got through the storm all right. We'll definitely be reaching out and touching base with you all down there. Do you have anything else to add?
No, go Cats.
All right, have a good one.